Hi, Jerry.
Hi, Kim. How are you?
I'm doing good. How about you?
I'm doing great, thanks.
Great. Thanks for meeting with me. Welcome to the Kim and Jerry podcast. And before we get started, I'm going to go ahead and get the disclaimer out pretty early, right?
Yep.
We're not CPAs, we're not financial analysts, or planners, and we're not attorneys. But what we share with you is for education and information purposes only. We have a heartbeat for investing in mortgage notes, and we're just sharing what we know to help others invest in mortgage notes, or if they're interested, invest with us. So tonight, the topic that I have chosen this evening to discuss, because we tend to lean on the side of non-performing notes and investing in seconds. Let's talk about first lien notes and performing notes, which is, you know, we do that too.
Yeah.
It's not as
Yeah.
exciting for me, but we do that too.
Yeah.
So
We invest in notes,
we
and
invest
just
in
for the
notes.
audience to know, we invest in notes. It's a great investment vehicle. They're great opportunities, whether it's a first position, a second position, a performing or non-performing. So you'll hear us talk about all aspects of investing in notes. And as Kim said today, we're going to talk about performing first liens.
Yeah, yeah. So, it's one of those things though, when I, talk about investing in mortgage notes with my cohorts and friends, etc. They're still trying to wrap their mind around investing in a mortgage note because it equates in their mind to, buying a house, right? The full amount of a mortgage note. And so when you're talking about a first lien performing note, the question I always get asked is, why is a first lien performing note even available to invest in? Because
Mhm.
it's performing. Why would the bank give up a performing note, right?
Yeah.
So, you know, um, I do my best to try to connect the dots for them and everything. And this is why I said, you know what, this would be a good podcast. Let's talk about it a
Yeah.
little bit. So
Yeah. Yeah. Talking to people generally gives us a lot of ideas for
it does,
podcasts.
right? Yeah. Ask me a question.
Yeah. All
So,
right.
what are your thoughts, and how would you explain that, as far as, why the banks give up, their performing notes that in the
Great
first lien
question.
position?
Yeah, that's a great question, Kim. And I think the best way to start is to talk about what is a note. Let's go back to the basics, the
Hmm.
fundamentals.
Yeah.
Um, we've said this before. A note is created when you are buying your house. When you go to closing, you sign the mortgage, you sign the note. It's all that paperwork. Those are the two documents that come out of that, out of your closing. The other thing to know about a note and about, we talk first lien, second lien. When you get a mortgage, the way the title companies work and the way the mortgage industry works, it's based on which one is first, which one is done and filed first.
Recorded.
It's recorded first, yes.
Right.
So a first lien is just the first mortgage recorded.
Hmm.
The second is, obviously the second, third, fourth, whatever. And how is it? How do we know which is first and which is second? When you sign the loan, the title company sends it into the county, and the county date and time stamps it,
Hmm.
and that's how you know what position a note's in. So you know that it's a first position, first lien. So I wanted to start with that to kind of give the basics and the fundamentals of this is where the note comes from. This is why we call it a first lien versus a second lien. It's just the one that
Right.
was recorded first.
Right.
Now, performing means that they're actually making payments on that note.
Hmm.
So you know that when you take out a mortgage, you've committed for some number of months or some number of years to make a set payment, a set monthly payment or whatever for that loan.
By a
So
certain date, right? By a
by a
certain
certain
date.
date.
Yeah.
Yeah. Um, so a performing note is one where they are they have made a payment within the last 90 days.
Mm-hmm.
So as long as you have a payment in there and that you're not 91 days late, it is a performing loan.
Right.
So that's kind of the definition for what we're going to be talking about today. We're talking about loans typically that are paying every month.
Yeah.
And
Yeah.
when we grade the loans, we'll have some loans that we'll say are B loans, C loans, D loans. And those are because people have not so steady payments, but we don't invest in those with our investment partners. So,
Right. Right. No. The payment history again from the borrower um, gives detail in regard to their paying habits, right?
yes.
Their ability as well as when they pay. You anticipate the payment at such a time, which it makes it more of a secure or low risk
Yeah.
type of note to invest in
Yeah.
when you're looking at that kind of factor in
Yeah.
regards to the payment history.
Absolutely.
And
Absolutely.
when we look at the grading the note, we grade when there are timely payments every month. That's definitely a grade A note. Um,
Yeah.
and all kinds of other things happen when notes are
Yeah.
graded
Yeah.
at that level. But when you think about a first lien performing note, for us, that's what we think about, right? A grade A note.
Yeah. Yeah. So you ask the question, why is the note available? To your point, the owner of the note, the lender, they're getting paid every month. Why would they sell the note? They're kind of, I'm going to say that there are two reasons for the sale. And everybody that's ever taken out a mortgage knows that very shortly after they've taken out the mortgage, they will get a letter saying that the loan's been transferred or sold or whatever. So the two reasons. First reason is in some cases, you're dealing with a mortgage company, and the mortgage company needs cash to write more notes. So they will sell the note almost immediately. In some cases, they'll sell them the day that they buy the note or that the note is closed in order to be able to get cash. Now, if you're not dealing with the mortgage company, if you're dealing with the bank, a credit union, and those kinds of folks, they also need cash. You can only write notes and you can only make loans if you have the cash to be able to cover. So the banks will sell the notes in order to generate cash to be able to write more loans.
Right.
So those are some of the reasons. I won't get into some of the esoteric things like balancing your portfolio and, but that is also part of why they will sell the note. The other thing that most people don't realize when they're looking at loans, so and they're looking at mortgages, is your amortization schedule.
Mm-hmm.
And anybody that has purchased a loan, one of the things that they give you is this table which shows principal and interest payments for every payment until the loan is paid off.
Right. Right.
The way amortization works, in the first 10
10.
years,
Yeah. 10 years.
it's mostly interest.
It's mostly interest, right?
Mostly interest. So if you're a bank, you can write a loan, collect the interest for 3-4 years, and then sell the loan for the price you pay for the amount of money that was invested in the loan. So
Right.
it's basically free money.
Right.
So
Right.
that's one of the other reasons that folks will sell the loan. I call it stripping off the interest.
Right.
So
Right.
they'll just strip the interest and then sell the loan. So those are some of the factors that will cause a bank or a lender to want to sell the loan. Other factors, and I kind of alluded to it, and it might be something that will happen with us, is you're trying to balance out your portfolio.
Right.
Let's say if you're an investor, you want $10,000 a month in payments. You may decide to sell a note in order to get a bigger payment from another note or something like that. They kind of balance that kind of stuff out. I won't get into all the esoteric stuff, but those are some of the reasons why people sell notes.
Yeah, yeah. And as we said earlier, the first lien performing notes make it easier to
Mm-hmm.
balance out, as you said, a portfolio,
Mm-hmm.
right? To bring some stability to a portfolio.
Yeah.
Um, it's a great asset for the passive investor who's looking for steady, constant, returns. And, the
Absolutely.
grade A note yields is better than average as far as the
Absolutely.
returns are concerned.
Absolutely.
So
Absolutely.
this makes it all very attractive to um, an investor as well as, to those who are looking to balance out and stabilize their portfolios, right? So,
Yeah. Yeah.
um,
Yeah.
as we always talk about the asset, the mortgage note asset is different as far as an asset in a portfolio as other assets, in that it doesn't have the same factors that would disrupt the investment, um, like the market, for example, right?
Mm-hmm.
And so you can always count on the investment that you have in a mortgage note in your portfolio because it
Absolutely.
doesn't it doesn't have the same kind of volatility that the other investments have. So,
Yeah. Yeah.
um,
And that's a key. If you are investing and you're looking at, for your retirement or something like that, you don't want to have an asset that changes value on a regular
right,
basis.
right,
And
right,
if you think about the stock market, you think about Bitcoin, you think about all these other alternative investment classes, they are very volatile.
yes,
That's why when you look at the newspaper, you always hear the Dow Jones is up, the Dow Jones is down, because those are volatile asset classes. With a
right,
note,
and
there's very little volatility because we're not affected by who's going to be elected. We're not
right, for
affected
example, and
by,
and that's a big deal right now, right? And
yeah, yeah, yeah. You know, um,
we need to think about that,
yeah, you're not, you're not affected by interest rate changes because the interest rate has been fixed, at the day that the loan was closed. You're not worried about a recession for the
Right,
most part because payments are going to be made. You think about it. When I say things like this, I'm going to try to put it in terms that we all understand. You have a mortgage, you got to make the monthly mortgage payment. It doesn't matter who got elected. The bank doesn't want to hear, I can't make the payment because so and so is elected president.
right,
You got to make your payment. If interest rates go up or go down, that doesn't stop you from having to make your payment. So part of the reason why this is such a great asset class from a volatility perspective is those environmental factors don't happen.
right, right,
People are gonna pay.
right. I mean, and to be clear, what is supporting that asset is the property itself, right? That's it's asset backed.
Mhm.
That's what makes collateral based, and it's double collateralized, right, in regards
Yes,
as far as an investor is concerned. So um the environmental factors that you were discussing don't impact the property,
yeah,
right? And so that's the asset that is supporting the investment.
absolutely,
So,
absolutely. Another thing that we didn't touch on, these, why do investors buy these? It's great for a tax advantage account. It's great for your solo
right,
401k. It's great for self-directed
self-directed
IRA.
IRA, yeah.
Yeah,
Um, you
the
can even use
college.
your HSA, your
Absolutely.
HSA account. You can use that as well, right?
Yeah,
To
absolutely.
purchase notes, which
Um,
is a big deal,
yep.
right?
So
So
like because the monies would just flow right in there. Those tax advantaged accounts actually are great for this type of an investment. The other thing to think about is that it's a steady boring type of an investment class. So if you have money that you want to get a better than average return on, and it's in those types of accounts where you're not looking at this on a daily basis for whatever, it's a
Right.
great asset class for that. So
Right.
uh,
Yeah.
again, why do investors look at this? That's one of the other reasons. And as Kim
Right.
mentioned, you said it was secure.
Right.
It's
It's
secured by the collateral that's
it's
backing.
basically Old Faithful.
Yeah.
Old Faithful in regards to what you're investing in.
Mhm.
Boring is a good word because it doesn't require anything
True,
because it's steady. It's
true.
steady. It's secured. It's performing. Um, it's not in a volatile situation. So,
Yeah,
I don't want to say, invest and forget about it, but, you could pretty much invest in it and forget about it. When,
true.
you
Yeah,
know, uh, as always, all assets should be, reviewed and managed, of course, and, ensuring that things are steady. But in the case of a first lien performing note, I can't think of anything else that compares, with as such an asset as this. And so,
absolutely, absolutely.
while I am a second lien non-performing note lover, it's always good to balance out with the first lien performing notes. And
Yeah,
so,
yeah, and I totally agree with you. For my own personal portfolio, I've used the non-performers, the returns on the non-performers to buy performing notes so that I get regular steady income. So
right,
um,
right.
it's a great strategy. One other
Yeah.
thing that we didn't talk about is liquidity.
Oh, yeah.
One of the things that you will see with other asset classes, whether it's stocks, bonds, um, electronically traded funds, anything that's traded, is that they are liquid.
Right.
And just like those assets, the mortgage market, the secondary mortgage market, is also fairly liquid. So if you are invested in this class and you see that you have a need to get cash, to raise cash, there are multiple ways of being able to do that.
Yeah.
Obviously, you have the ability to go out and sell your position
Hmm.
and sell your note. Typically, we buy with a discount so we can sell at a discount and um, capture that discount when we sell. But one of the things that is very different about this asset class over some other other investment vehicles, is we can do things that we call selling a partial.
Hmm.
Selling a partial means that we can sell half of our monthly payment
Right.
or a quarter of our monthly payment, and people will buy that payment stream.
Right.
Or, which is really kind of crazy. And when I was first taught partials, I can sell years 2 to 5, or the first 15 years, or the back 12 years, or something like that on a note. So the
And
market,
let's talk about why would you do something like that? I mean, what would possess you to sell your payments to another investor?
I'll give you a
While it
perfect,
sounds crazy, it's really genius. You
yeah,
know,
I'll
it,
give you a perfect example. You buy a note today for whatever.
mhm,
Let's say you spend $30,000 on a note, and you got great payments, or a couple $100, maybe $500 a month coming in, and the note is a 25, 30-year note. Well, you have a kid that's going to college in 10 years. You don't need the money today. You don't want to pay taxes on the money today or whatever. So you sell that to somebody else to recoup some of the money you put into this note. And then when your kid's ready to go to college, you got money coming in every month to pay for them to go to college.
right, right,
It
right.
sounds crazy.
Yep, yep. Payments
But
can be used whatever you need it for,
yeah,
a
but
vacation, a new car, and without taking out a loan, right? Without
yeah,
taking out, you can
but
sell
yeah,
payments to get the money that you want or need for whatever the circumstance may
yeah,
be.
yeah. And by the way, at the end of the day, you still own the asset.
You still
Unlike the
own the
stock
asset.
market or, the bond market or something like that. If I want to get my cash out, yes, they are liquid, but when I sell, I sell.
Mm-hmm.
And stock goes up, stock goes down, it doesn't matter. I'm no longer in that position. But with a
Right.
note, the wild part, the fun part for me is knowing that I didn't have to sell 100% of the asset in order to be able to get cash out.
Right.
And that can be a very attractive thing for some people.
Yeah. Because, then there's life, right?
Yeah, yeah,
And stuff happens.
yeah,
So, you have this in your portfolio to be able to leverage for what you may
true,
need it for.
true.
And so, yeah, I will say it's very attractive to the investor to have that, on hand to be able to use it. And, there's a whole another investment group of people, just like I enjoy the seconds and the non-performing. There are people who seek to get these type of notes for the purpose of having to, this, the strategy is to sell partials, right?
Mhm,
And
mhm.
so, it can be very sophisticated as far as the note investing industry. There's a lot of not just exit plans, but ways you can capitalize on your investment, right? And it's certainly anything that you can do with a physical real estate property, you can do that, with a note as well.
Yeah,
So,
yeah,
um, which is also, interesting of itself. So,
yeah,
it's not so straightforward, not so straightforward, but it does make your portfolio uh, interesting, and you can leverage it for whatever you may need it for, even for circumstances you probably weren't even thinking about, but that all of a sudden it dawns on you, right?
yeah.
So yeah, um this has been good. Like I said, first liens and performing notes uh is a whole nother type of investment, and it's not as difficult to attain. There's ways you can uh, invest. You talked about it a little bit with your tax accounts that you might have, but people think about, if I wanted to invest in a first lien, I may not afford or be able to buy a $500,000 mortgage note, right? Um, but there are all types of first liens that
Mhm.
are available for purchase and investment, right? And there's opportunity to even JV, right? Or come together, pool together to invest in notes that give you that opportunity to build your portfolio using first lien performing notes. That's probably another podcast.
Yes, it
I'm
is.
I'm stumbling because it's another
And
topic, and
you um as we've been talking here, I think that you could possibly do a whole podcast on partials. You can do a whole podcast on um, what the impact is on an investment account. You can do a whole podcast on, you know, mortgage notes versus other securities. So I think through
and
the
a whole
course,
nother podcast on how to attain and how to be able to purchase, right?
absolutely,
Um,
absolutely.
it doesn't
So
have to be, straight out of the pocket, and
yeah, yeah.
there's many ways that you can invest and achieve the same goals, even. So,
Absolutely. So I just think that one of the things that we're trying to do is share our experience, share our knowledge, get more people invested or interested in this investment in this asset class. Um, and I think, basically, Kim, you're trying to come up with part two for this.
Well, and also, if anyone is interested, if you have questions or if you want to say, when you said, and you said this on the podcast, can you give me a little bit more insight on that? We welcome that kind of conversation.
Mhm.
Um, we have an opportunity where you can, arrange for a one-on-one with either of us through the website, which is firstshieldfinancial.com. And it's a short meeting to go through, ask any questions that may need a little bit of clearing up that we've talked about on the podcast. Or explore maybe your interests or discovery, or you never thought of that, and can I do this with that? We have what we call our investment group is the Shield, and we come together every Friday, and you can even be a part of that setting where there's a team of us who are sharing all kinds of investment type of strategies, and asking all kinds of questions, and sharing their own experiences with investment with notes, right? So that's another opportunity to be able to look at whether or not note investing is for you. It's not straightforward. There's not just one way. Not every note is different. I always say that. And so if this piques your interest, I say, please, take a look at it, take a closer look at it, and see if we can help you with that.
Okay.
Anything more you want to share, Jay?
I think we've covered everything that I wanted to talk about today. But I will say, if you like what you heard, if you are interested in what we're doing, please hit the subscribe button. As Kim
Yes.
said, you can get a hold of us and ask any questions you want. Go to our website at firstshieldfinancial.com, www.firstshieldfinancial.com, and book a time to talk to either one of us or one of the other folks on our team to find out a little bit more about mortgage notes.
Yeah. Yeah. Well, thank you again, Jerry, as always.
All right.
All right.
Thanks.
Thanks. Take
All right.
care.
Bye-bye.
Bye-bye.